we talk about Fundraising 101. And we are so lucky to have Mr. Kevin Yam from Wingcaps Capital be our speaker for this section. Mr. Chong Tun Ping for the Faculty of Business and Finance, FBF. We introduce the program from the FBF. Before sharing our topic today, let me introduce our speaker of today's live webinar. Our speaker, Mr. Kevin Yam, is a founder and managing partner of Wingcaps Capital, and he also a Utah alumni. Wingcaps Capital is offer founding, guidance, and resources for startup of business. Mr. Kevin Yam, with 10 years of experience, achieved proven track record as executive director in the information technology and also service industrial. He is a licensing financial planner with an FPC, and he has developed a sharp eyes for business track and is able to give SME startup advice and how to scale up and promote growth. And his passion now included consulting corporate and SME on fundraising, besides being appointed as a CFO and advisor for business. His next goal is to achieve 500 million funding for all for as many potential SME or startup in Malaysia with the next 5 years. So now let's welcome our speaker, Mr. Kevin Yam.
I'm very happy and honored to be able to share with all the audience today as part of Utah alumni. So, ranging from my experience being a fundraiser for most of companies and startups, especially we started during the COVID period, it's not easy, but at the same time, it's not as tough as anyone would think, especially for young entrepreneurs and also those who are wanting to start up and do not have an idea how to make your fundraising a success. So over here today, I will share most of the details or what I would say is the fundamentals for fundraising. So at the least you will have an idea how to start, where to start, and what are the key items to prepare before meeting your first investor. So without further ado, I'll share with you my screen. For the fundraising 101 side, I think the first few major key points that we have to go through is actually what are the successes in the entire market and those who have actually been in the fundraising market. So as you can see from the next slide, okay, the first one or two case study is all about those that have already gone through fundraising. Now, let's look into the second case study over here. It's called Dropee. Dropee is a Malaysian-based B2B wholesale startup. So I'm very sure some of you all might heard of Dropee if you're using e-commerce or even have your own e-commerce startup. Okay, Dropee is a very intuitive platform that integrates all e-commerce wholesale platform, including inventory management, logistics, and most important of all, customer fronting that integrates all the other e-commerce platform through selling. So with this success, Dropee came to fundraising and land its first Series A. Okay, so for all the audience today, as you can notice, there's a word or a platform called as Series A. Now, in the use of Series A, there are multiple words that you might see. Okay, Series A, seeds, or pre-seed. I will explain to you much later. Okay, next slide. Okay, for Urbanmetry. Urbanmetry is also a very brand new startup that just won 2 million USD in pre-Series A. Now, what's the difference between Series A and pre-Series A? Now, the simple definition is Series A are companies that has already traction. They have already gone through the first round of funding. They have got their revenue, and most importantly, they have net profit. So those are called Series A. Now, when you meet companies called pre-Series A, so pre-Series A companies are those who have not generated positive net profit, or some is not even generating revenue yet. So that's why it's called pre-Series A. Okay, so anything before pre-series A, we would actually consider them as seed round. This money is seed money whereby you need investors first round of investment to show proof of your success, to show that your idea is not just an idea, but it can carry out as something that is acceptable in the market. Then you start to build traction. Now, when you start to build traction, if your traction is good, you have revenue sales number and generated net profit, yes, you qualify to Series A. Okay. Next slide. Now, let me just share with you all today what's the most important about external funding. Benefits, there's a lot, but let me share with you one of the most important reason why you should go for external funding and not what conventionally internal funding goes for. First of all, the importance of external funding is you have to get validation from the open market. Why we talk about validation? Now, when you come to think about funding, everyone would always think, oh, I can ask my father, mother, I can ask my friends, I can ask my uncle, auntie, or anyone I'm close to. Those are not called external funding. Those are still considered as internal funding. The reason why internal funding doesn't really work that well is because family members or those who are close to you, they might be thinking, okay, I might be allowing a very good opportunity for you. But little do they know, what we call this as a relationship bias would happen. Now, once you receive funding from the internal side, being very frank and honest, with my 10 years of experience in my own company and watching others going for the same road, it's not going to be easy and it's going to be tough. So, how do you mitigate such tough or challenges that you may face, such as just in case your uncle or auntie needs the funding back, how are you going to manage? If your father, mother needs back the funding, how would you manage? So things like this is going to be very tough because when you started, it's all based on internal funding and there are no proper agreements being made. So it's very, very, I would say, very dangerous for the business unless you are really stable, you are really having a firm hand on what you're doing, then yes, you may try from internal funding first. Now, of course, everyone knows that external funding is the toughest. But why? Why still companies go for external funding and why you should too? One is the open market. Whenever people talk about ideas and talk about how good a company goes, everyone can actually see, everyone can evaluate. Is the product good? Is the company formation good? Is the founders and the team strong enough? That's why we all go for the open market external funding. People can do validation. People can understand if you're really good when you're in the open market, people will know how to go to you. So you do not need to worry. Okay. Number two, when you're going for external funding, you may have suppliers, you may have customers which are able to see what you're doing. That's where you make your first sale. Okay. When you're selling to your customers, if your customers are happy, if your customers know who you are, if they can see your business model is a good business model, they definitely will request for collaboration or even a further investment. Now, on the supplier side, it goes the same thing because if you're taking the supplies from the supplier, they may think, hey, if this is a long term relationship and your business might be good, why not I invest? So such things may happen. And this is the best type of collaboration that you want for your business to go for long term. Number three, synergies. Synergies is something very unique and also very hard to achieve as of these days because competition and competitiveness is the opposite of synergy. When we talk about synergy, I think I have a very good example to share. Let's assume an IT company that's doing website design, okay, and another company which is doing domain hosting and also technical support. Two separate companies, if they are helping each other to make sure that the product is very good in the market, yes, two parties can join up together as a synergy. Okay, synergies bring a lot of help, especially for the domain company or the support side, which is helping the website design side. Okay, so for startups to start small, yes, no doubt, you have to start very small, and everything has to be done on your own hands. Now, if you can find synergies and multiple synergies gel up together, you would well have a group of partners that can steer the company forward. Of course, the last but not least, if you go for external funding, the first thing that you have is direct corporate branding, and you can also position yourself to have a grand launch of your product, company, or even a solution. The most common practice for corporate branding and grand launch during funding is something called as equity crowdfunding. Now, equity crowdfunding is something very unique, which I will also share later in the slides. But these are the first main key points that I'm sharing with you all. So at least you all know what is it all about first. Okay, next slide. Okay, now in the open market, as we have mentioned just now, how do you attract your investors? So these are the way that normally startups do. If you can see, those customers which may be your immediate converting customer. For this case, we are taking a public information. This is from one of the equity crowdfunding platform, and the client at that time was BMS Organic. If I'm not mistaken, this is from Pitch In. So when this company is doing their equity crowdfunding, they are looking for investors to invest, and this is the investment amount that they are giving out. If you do notice, on the 1, 2, 3, 4, 5, on the fifth column, if you invest 1,000 on package A, they'll give you 200 ringgit worth of voucher. If you invest 30,000 at package F, you get 6,000 in terms of vouchers. So this is one of the ways that companies are going to the open market to test if their business is good, if their product is good. So at the same time, you can do fundraising. At the same time, you can do sales. That's of course one of the best approach in the market there is. Next, this is a very interesting one. Now, Binance, the founder he himself is very strong in terms of IT. He created a lot of strategic partnerships because at that time, cryptocurrency was rather new. Crypto space was entirely based on trust, based on faith, and that's how, in terms of collaboration, brought up the success of Binance. If some of you all over here do have knowledge in cryptocurrency, you all would know Binance started up at a very, very low point of only around 10 cents at its first issuance. And a lot of clients and a lot of suppliers, example, their data center supplier, their first round of investors, were also part of those who believe that, hey, cryptocurrency may be something very new. At the same time, when they wanted to do it, it's not so easy. Since someone is taking lead and he knows what he's doing, that's how strategic partnership comes about. Okay, Binance is actually one of the great stories that you all can read on your own. So I'll skip for now. Next. Okay, synergies, as I mentioned, uh, suppliers don't normally provide capital for a business in the form of cash investment. However, they do offer credit. Now, if you have anyone which is currently working as a manufacturer, working as a major supply chain supplier, as a startup business, those will be the first to be a supplier and supporter. Reason is because if your business is doing good, you're starting to order in big bulk, then your supplier is your first potential investor. You can tell them, hey, I'm not asking for a very long term loan, but just hear me out. Just give me 30 days credit. And when I can sell, I can pay you back. Such kind of first round, or I would say is through financial knowledge, you can know that some suppliers do allow 30 days to 60 days repayment period. So if your business is doing good and you're taking on a bigger amount from your suppliers, most of the time they will definitely allow the credit. Now, once the credit is given and your business is still growing, why not hook up your supplier to invest in your company, and you can go the long run together. Okay, next. Okay, yep. Oxwhite is also one of the company that has smashed the record previously, and of course, a lot of companies eventually has raised more than 1.2 million USD in the equity crowdfunding platforms. But for Oxwhite, I'm not sure. Do you all know their background? The founder has created a very popular marketing method, and his marketing focus was actually very razor sharp. If you're able to share this brand to five of your friends, you may get a, a shirt at a price of a 110 ringgit. Okay, so that was his marketing technique at that time, and of course that is to garner as many outreach to the market as possible. Once everything was ready, he went to the ECF platform, and there you can see he has 485 investors that back his company. So this is something very important for those who are keen to start up your business, to understand marketing is very important. Your selection of your platform is also very important. Are you ready to launch, and how you launch? So item number four, when you're ready, corporate branding and a grand launch is a perfect match. All right, next. Okay, the types of fundraising. Now, this is actually very important for all the aspiring entrepreneurs that you're stepping out into the open market one day. Please do remember this very important. Equity-based funding and loan-based funding is two different type of funding, and most of the cases these two do not mix with each other pretty well. Okay, for equity financing means that you are exchanging your ownership in terms of shares with an investor. What are the ways you can do that? Is you're selling your ordinary shares, your preference shares, or other equity-like instruments such as uh, redeemable convertible bonds, sorry, redeemable convertible preference shares, and restricted preference shares, or irredeemable preference shares. Okay, again, those are shares. Anyone that has invested in equity base, those investment are in the form of share, and it will only do in the form of profit sharing with you. They are your direct partners. The difference between equity and a loan base is the returns under equity is called dividend. The loan is called interest. Okay. Now, for the loan base, we call it as debt financing. That also have its multiple instruments that they can work together with you. The most very basic is called a loan. You can go for a term loan. The second one is lines of credit. Lines of credit was the one I mentioned. If your supplier is able to work together with you, he can start up lines of credit with you, allowing you to take more order from him before committing further. Example, if he's already given you 30 days of credit and you're doing it very well, and potentially you may offer shares with him. After that is done, most of the cases is he'll start to lower down the credits of lines of credit and invest more on the equity side. That's how you actually move from loan to equity. Now, the best part is always moving from loan to equity, but not the other way around. The reason is very simple. Interest is always something you have to pay before you pay your dividend. In short, if your investors are heavily invested in your company and you're taking a very big lump sum of debt, your equity investors are not going to be happy because you are paying you are paying off the debt, then only your investors get the dividend. Okay, do remember this in mind, yeah. If you're going for equity, just focus on equity. Do not go into the debt financing unless you are necessary to go into debt financing. Okay, next. Now, there are 7 ways to get funding. Okay, these are not just the only 7. Of course, there are more, but we only focus to the 7 ones which are very focused and very how do I say, the norms in the market. The first one is called bootstrapping. You get it from your own hard work savings. You talk to your friends, your family, and of course, the last one, some of them might be fools. Okay, reason why we say that is because some of them they have the amount of money and they just leave it there and they do not do any financial planning. So we consider those as fools. Okay, number two, equity crowdfunding is very important. Equity crowdfunding is more towards a platform whereby there are hundreds and hundreds of investors in those platforms. However, the downfall is always one thing. If you perform very well, everyone there will see you very well. If you perform badly, the group of 100 over investors over there would have seen your pitch, would have known that, oh, this is a company I should avoid, or this is the founder, I think he's not prepared to start a business yet. Hence, it will lessen your chance for the next round. Equity crowdfunding is very good, but only for those who are really ready. Okay. And next you have P2P. P2P is basically called as peer-to-peer. P2P is more towards debt funding. If you're doing e-commerce, if you're doing high traffic or high transaction based on the amounts of trade you have, selling a lot of items such as female products, FMCG goods, you're selling a lot of electronics as well. P2P might be a good platform. Okay. Okay, number four, angel investor. Now, angel investor, they have a group called MBAN, Malaysian Business Angel Network in Malaysia. So those angel investors normally go there to look at deals, to look at what are new startups coming up. Now, what's the difference between angel investor and bootstrapping? Angel investor is an outsider. He doesn't know you. He have no prior engagement with you, and you are building the relationship from scratch. Now, angel investors, if they already have the faith in the industry, in the in the sector, and in what you do, most likely their investment will be firmed up. Now, the difference between bootstrapping your raising from your friends and family is they know who you are. Hence, I call this a relationship bias. When they know who you are, there's always a positive and a negative. The negative side is, as of any time, if they request to put it back, it's also due to relationship, and the relationship may go sour, irregardless of which type of relationship you have with your relatives or even your family. However, on the angel investor side, when they invest, everything is done properly, everything is drafted through legal agreements. So it is a legal binding agreement with you. So you know what you're doing when you sign on that paper. All right. So it's very, very important to know what you're doing. And if you're not sure of what the terms the angel investor has given, please do always get a lawyer or get a consultant like us to help you out. All right. Number five, venture capital companies. Venture capitals are companies whereby investors give them a lot of money. They seek for interesting projects and they want a good return. Normally, VCs they are looking for around at least 20 to 30% return per annum, or if the company can give them good return over the next 3 to 5 years. The stress in venture capital are much more higher compared to angel investors because venture capitals have a bigger group of investors that are always pressuring them as well. So angel investors will be the best ideal scenario to have. However, as we all know, it's not easy to meet an angel. Okay. Number six, family office are very unique. Family offices are more to groups of company with the surname such as the Tan family, and they are very rich. So those are called family office. Okay, so basically they are very big in terms of the business conglomerate. I'm sure you all heard of Robert Kwok. So Robert Kwok, the name Kwok office or the Kwok family, that's what they call as a family office. Okay, the whole generation or the whole conglomerate itself is very investment focused. Meeting them is not easy, and most of the time they only invest in very matured companies. Last but not least, grants by the government. For that, okay, good luck because grants, it depends on what type of grant you're taking and what kind of grant the government is giving. Okay, next. Okay, there are 4 stages of funding. Pre-seed is again very early. Pre-seed is before you even start to generate your first revenue. And then the next one is called the seed funding. The third one is called Series A and all the series. And then after that, it's going to go for IPO. Okay. Miss Jeline, the screen. Okay. Uh, for pre-seed and seed funding, it's more towards when you have a good idea, you're ready to go to the market, but you're not too sure how far are you going to go. So you are definitely under the pre-seed and seed funding. Series A are for those who already have revenue, you already have net profit, and you're moving upwards. So you know the Series A, B, C, D, they already have generated net profit. The other words such as BCD, it shows that you have double or triple or even tenfold in size. So that's why it's called a falling round. Last but not least, the IPO. IPO is most of the time for the exits. Okay, so today we're not going to talk so much on the IPO. We're going to talk further on the pre-seed and seed since you all are much more towards aspiring founders. Okay, next. Okay, pre-seed funding is very small. It's idea development, just enough for you to test your market. So most investors will invest from anywhere around 10,000 to 50,000. Not too much, but just enough for you to start. If you raise too much, there is also an issue. The issue is because you do not know how to manage the funds well, and then on the subsequent fund raising round, you will have issues of that. So don't raise too much, just enough to start your idea, just enough to start the company. You as the founder, you need to bootstrap, and then you can move on to the next round. Next. Seed funding is the most common ones. You have to get your website done, or you have to get your app done, or you have to make sure your product is perfected. Then you can hit the market. So what you have to do is you have to keep on building attraction, test your market and everything. Then you have an official launch. Remember, before the launch is called seed funding because you haven't actually garnered actual real market users and also sales numbers yet. So those are called seed funding. Now, do investors invest in that round? Yes, they do, but you need to know what you're doing and how to position your pitch decks well. Okay, next. Series A, B, C, D, all the ones onwards are already, you've got the sales, you've got a good working business model, you're trying to expand your business from one region to another, one country to another, or even acquiring your competitors. That's why when you're expanding, investors will definitely invest more. All right, next. Okay, IPO today, we're gonna skip this point, but always do keep remember, IPO is always the best exit plan for everyone. Okay, next. Okay, this is very important. Now, when you talk about the business timeline and of course, developing the business roadmap, you have to understand what you're trying to do, what you're trying to achieve for each of your own company and products itself. From on the left side, on the gray box, you can see securing the partnership in 2020, establishing international partnership in 2021, becoming a leader in wealth management AI, maximizing shareholder value. Those are things that you want to achieve. Okay, those are things you want to achieve. Now at the bottom side, ECF roadshow, secured 2 strategic partnership. Then 2021 platform launch in Q2, acquired 10,000 users, going for IPO OTC in the US, secured 4 strategic partners. Now this is the difference, or what we call as the traction investors want to see. They want to see how much have you grown from the day you start onto the next year. Okay, in the year 2022, global expansion, and of course 2023 uplist from OTC to Nasdaq. That means this is a very big company in within 4 years time. Now with that said, investors will think, would you as the founder be able to deliver such a big deal or such a big growth in 4 years? Of course, you have to build up your team, you have to build up your company to show that you are as strong as possible. Then investors would be willing to invest. Okay, next. Now, just to share with you all, what you need to showcase your traction or partnerships. First that you need is the letter of intent from your partners saying that I am keen to work together with you and I intend to work with you. Okay. Number two, memorandum of understanding. MOU is mostly for big companies, but of course, number three, traffic and leads. If you are an app or you are a website, traffic and leads are actually your tractions. If those numbers are growing, keep it up and make sure they grow even higher. Number of active services, those are very important for apps to show that there are real users and they're using your app on a daily basis. Last but not least, sales. How much revenue have you generated or how much product have you sold? Those are the most solid traction. All right. Now, partners and clients are very, very unique. Reason is because partners are those you can have a strong working relationship with, and clients are most likely big names such as Utah as a university. Are you having any relationship with Utah? Like us, Vincaps, we are having relationship with Utah as a very start, but it's still too early to name as a client. Then maybe we can consider to start as partners into events and so on. So this is already a direct showcase and practice what we are doing. All right. Next. Now, this is one of the most important page and slide investors want to see. And to all audience today, please do remember this page, you have to focus all your attention when you're building it up. Each and every single number, you cannot have a mistake or you cannot have a screw up. Okay. All based on the left hand side, the revenue projection, both based on ARR and MRR. ARR stands for annual recurring revenue, and MRR stands for monthly recurring revenue. Now, your annual and your monthly both have to grow at the same time, but you have to be very cautious not to fall into the exponential growth, which sometimes might just seem impossible. Okay, so you have to juggle at both numbers. Number two, sales and marketing expenses. How much are you spending to get your customers? Technology expenses, such as the cost of hiring an IT personnel, the cost of maintaining your website, your apps, or your servers. The following one, payroll expenses. Payroll is more towards your team and management. What are their salaries? You have to take account on that. Number five, headcount projection. Now, you have a team of, let's assume, 4 to 5 members to start with. How far are you going to grow? How many people more are you going to bring into your team? So you have to look into how many people that you're looking at in the future. If you assume that I need marketing to help me grow, then you need to hire more in terms of the marketing department. If you need more IT people to ensure that your product is the most latest in the market, you want to be innovative, then you need to get more IT personnel. All right. Last but not least, you have to understand what is the burn rate. Burn rate as in how many users onboarded and they left within the first year. Okay. And then, of course, within your company itself, the burn rate will be how much revenue are you spending. All right. EBITDA, earnings before your interest, tax, and dividend. So those numbers you have to be very sensitive with because investors are always asking about numbers. All right. And if you're not sure with your numbers, please do not ever lie. You can just tell them, let me get back to you. Okay. Do not just jump any number to them because if that investor invested in you, they expect you to commit that number. Okay. You have to deliver. Hence, if you're not sure, if you need to check, just be honest with them. Sorry, dear sir, I need to check back with you and let me get back to you this evening or the next day. And make sure you do follow up after that. All right? Next. Okay. These are the financial figures and the metrics. You may want to screenshot or you might want to take a picture of this. These are the numbers frequently asked by investors when they are keen to start investing. Okay. For SaaS models, you can look on the right hand side, but most of the business on the left hand side, gross margin ratio, earnings per share, price earnings ratio, debt to equity, return on equity, and price to sales. All these are the questions investors trying to determine how well are you doing. It's just like a, a key diagnostics to our body checkup. How healthy are we? Then they look at the heart rate, so on. But this is for the financial side, gross margin ratio, earnings per share, price earning ratio, and so on. Now, if you want to ask me, do we have a benchmark? I can be very upfront. There is no benchmark. It all depends on your industry. It all depends how fast are you growing. Okay. Now, on the right hand side, you are looking at a SaaS model. SaaS model means software as a service. Example, you created an app. You feel that my app can help a lot of people, so you are charging people to use on your app. The most simple one is we can look into today's market is like Wix. For those who are trying to start to do websites, Wix is a SaaS model company. Airbnb, they are also SaaS model basis. So it all on the website or digital. Okay, easy to understand. Now, at the bottom side, capital efficiency. It means that how much have you invested in your company and what is the result that you've generated today. Example, if you have an amount spent in number of months and you reach a certain amount of revenue in 1 year, investors will understand, are you doing very well or are you not doing well at all? The following one, how much money has been left uh, since your last round? They're trying to gauge how fast are you burning. Number three, what's your monthly burn rate? How much money are you spending every month? And of course, the last two question, what is your runway? Runway is the number of months you have to sustain your team before all your capital has been dried out. Okay. And last but not least, investors always want to know how long after investment it will be profitable. For angel investors, they are much more patient. For VCs, not so patient. VCs expect you to be profitable most likely in within 1 to 2 years. All right. So you have to be very cautious when looking for your right investor or the right investment partner. Next. Now, today I think we are just going to go for a very simple evaluation method. One, we call it the revenue multiplier. Number two, we have the PE ratio. And the third one is DCF, discounted cash flow model. Now, the first two models are very straightforward, used in the market, while the third one is all depending on how much are you earning. That's why they call it discounted cash flow model. Now, revenue multiplier, in short, sometimes they will call it PS. How much sales have you earned from now? So let's just make an assumption. If my company has already done a revenue of 10 million, and within my industry is the fintech industry, fintech has around 10 to 15 PS or 10 to 15 PE ratio. That means our company on a revenue multiplier basis is at least worth 100 to 150 million. Okay. Now, for the PE ratio, PE drills down to your net profit. Okay. Your net profit. Then the price upon earnings. That's where you get your exact number. Price is most likely on what price you want to sell, and earning is how much you have in your net profit. Okay, so normally if your PE ratio is, let's just say again at 10, just for simple calculation, the PE ratio is at 10 and my company has a net profit of 1 million. That means based on the PE 10, my company is worth around 100 million. Okay, 10 times 10. All right. But DCF, discounted cash flow model, it all drills down to how much money are you able to earn. And from there itself, you have a work back model. Okay. How much it has to be discounted for certain factors and certain timeline. Okay. So that's called DCF model. DCF model, sometimes when you look into brick and mortar business, those are more towards DCF model. PE and revenue multiplier are towards industries which are much more fast moving, e-commerce, IT, fintech, and so on. Okay, next. Now, pre-money valuation and post-money valuation, I don't think we'll be touching much. So in short, pre-money is before the money has been invested in your company. That's called the pre-money valuation. And once you have the investment amount, and then what you have eventually is called post-money. The difference is the percentage that you have to give out to your investors. That's the only difference. Okay, so today we are not gonna touch on that because today is more towards fundraising 101. So pre-money and post-money valuation, there are many ways to do it. So you have to seek your own consultant or the right person to talk to before proceeding. Okay, next. Now, issuance of share is very straightforward. Now, if you go for issuance of new share, it's towards investors on the left hand side. Okay, this one it would depend very heavily on how much is he investing based on either ringgit and dollars, which go to the number of shares, or investing in terms of the percentage. I want 10 or 20% of your company. So those are the investment methods. Okay, last but not least, proceeds of share. Of course, some of investors might think of exiting or investing into the company. So it all depends on how things would proceed. Okay, so from there on, proceed of share and issuance of new share. This part, I believe you have to talk to your company secretary, and they'll give you the best advice on that. Okay, next. Okay, this is a cap table. You might want to take a screenshot of this or take a picture of this as well. So the small other sample of a cap table is how your capital is being built up. And of course, with the share price is a little bit confusing to some. The reason is very simple. Share price of a company is depending on how well the company is performing. Even for the company which is not yet listed, okay. But then within the capital and the company's growth, this is actually how things are going to be proceeding in future. So at the least for all the startups or founders that you are today looking at this, it shows to you things can be done flexible. It all depends how you negotiate with your investors and how are you going to plan your investment for the investors coming into your company. Are you giving out more partner shares, more preference shares? It all really depends. All right. Next. Okay. I think we're coming to the end of our fundraising 101. So I'll just share with you the types of instruments for fundraising. Ordinary shares are meaning shares that would allow the investor to be your direct partner. They'll participate in your business on a day-to-day basis. Okay. Preference share are for investors which are they may feel that I want to invest money with you, but I'm also scared at the same time in case anything goes wrong. Now, if you have learned before company act and the company law, preference shares are the position whereby in case anything goes wrong with the company, then the investors will be able to take their money out first, and ordinary shareholders will be the ones who are at the last. Okay, again, preference shares, they will be able to take out first in the case of liquidation. In case the company goes wrong, they'll be the first one to exit first. All right. Then you have convertible loan and term notes. Convertible loan are loan, okay, in terms of debt, but you allow the investors to convert it into shares in the future timeline. Now, it all depends on what is the conversion ratio. Most of the cases, you allow investors to convert upon reaching the maturity date or upon reaching the entire business tenure. You're going for IPO, you inform your investors that, hey, I'm going for my IPO soon. So the convertible will be based on a discounted IPO price basis also can. Okay. Now, last but not least, term notes. Term notes are a very basic line of credit terms or what you call as loan terms. So those are for short term towards medium, whereby those notes may stretch on from 1 year to 3 years basis. But again, convertible loan and term notes fall under the debt side. Okay, so if you're not confident, do not touch on the debt. Still focus on the equity side, because equity shows the strength in fundraising and the management of company Last but not least, investors' confidence. Okay, with that, I end our presentation over here.
Okay, welcome everyone. Okay, I would like to take this opportunity to share with you one of our program, okay, which is the Bachelor of Business Administration, Owner Banking and Finance. And then for information, actually Kelvin is one of our alumni for this program. Okay, and then generally for this program, basically is in a 3-year program. Okay, then let me share with you the program structure. Okay, then in year one, basically, students are required to take several courses. Okay, and then definitely in the year two and also the year three. In total, there will be 120 credit hours, okay, which span through a diverse type of courses, okay, that's available. Okay, for example, you can see on the screen, we have courses from the common core category, we have discipline core categories, we have specialization, elective group, compulsory courses, elective group, and others. Right. Okay, then this will be the courses that let's say if you enroll for this program, okay, this let's say in the year one trimester one, okay, there will be like 5 courses in the list. Okay, then followed by the year one trimester two, okay, there will be like about 6 courses. And you notice that there's one group, okay, which is at the bottom here. There's a language. Okay, this means the students can actually choose the course, okay, from the list here, right? Can I follow by the year one trimester three? Okay, there'll be 3 courses as well. Okay, and then for information, in Utah, okay, we actually apply 3 trimester in a year. Okay, and then for information, okay, there'll be like 2 long trimester and also 1 short trimester. And then for long trimester, there'll be 14 weeks classes. Okay, while for the short trimester, there'll be 7 weeks classes. Okay, further to that, okay, this will be the year two program structure. You can see on the left, okay, there's a year two trimester one. Okay, that means student will actually take okay, several courses, okay, as per the list here. And also in the year two trimester two, okay, there'll be courses as well. Okay, then definitely the courses that's are diverse and they're different. Okay, and also you notice that in the year two trimester three, okay, then student they have to undergo an industrial training. Okay, that's why they'll be placed in a company to undergo a 12 weeks okay, internship program. Then further to that, in their final year of studies, okay, this will be the year three program structure. Okay, then you notice that there's one research project. Okay, there's research project, okay, and also the research project. Okay, so for students for this program, they have to take the research project, which is also well known as a final year project (FYP). And then in here, they have to take a research, conduct research, and then they need to write a report and also to present okay, to the committee or the examiner. And then you can see from the list, okay, there are also diverse courses okay, that's available. Then, okay, to give an overview, okay, what are the focus for this program? You can see from the list, okay, there are 10 specialization courses, okay, in which we have this money and banking management. Okay, number 2, financial derivative, risk management, international finance, financial institution operation, commercial bank management, credit analysis and lending. Okay, number 8, we have banking operation and treasury management, Islamic banking, as well as the last one is the anti-money laundering and counter-terrorism financing. Okay, about that, there'll be 2 focus in here. That means students they have to take a research project as well as to undergo industrial training. And then for this program, also we have the professional accreditation, okay, or the collaboration with these external bodies, okay, such as we have FPOM, MISA, MAX, ACCA, CFA, AICB, MFPC, CIMA FLP, and also the FAA. Then, okay, let's say the student they enroll for this program and graduate. Okay, what are their career pathline that can be? Then this will be the list of the sample okay, that we show over here. For example, the graduate okay, they can become the credit control officer, okay, sales executive, collection officer, corporate finance analyst, relationship manager, okay, stockbroker, fixed income traders, research analyst, multi-strategy fund analyst, unit trust consultant, and branch manager. And definitely the list is not restricted to here, right? And then next, okay, what are the market demands? Okay, this will be the study okay from the on the 25th of October. And then from the LinkedIn, okay, actually they posted about 6,000 plus job okay that's relevant to the banking and finance the job. Yeah, then from Glassdoor, okay, there's about 2,500 plus, and also from JobStreet, there's about 1,400 plus. Okay, so let's say you enroll for this program, do not worry. Okay, there's a huge demand. Okay, for these graduates, right? Then next, okay, in terms of the salary scale, okay, I believe some of the students, okay, or the people, okay, or the public, they are interested with this. Okay, then according to the Job Street Salary Report 2022, you can see from here, okay, the banking and finance graduate, okay, the newly entrants or non-executive position, okay, they'll start with the 2,050. Okay, let's say if you move to the senior manager positions, okay, then you're expected to earn 13,000. So basically that's we range from 2,000 and 30,000 if let's say you graduate from this program and you actually work in this banking and finance industry. Right. Can I second from the Glassdoor 2022? Okay, from this finding, okay, we noticed that okay they reported like about 10,000. Okay, that's the potential salary earned okay by the Malaysians. Can definitely the minimum can be 3,400. Okay, then it goes up to 7,000. Okay, and then they can go up to even like 16,000. So this would be a very attractive and lucrative okay market if actually for the public as well as student okay for to enroll for this program. Right. Can if let's say you have any question pertaining to this program, feel free to contact us. Okay, you can contact to me, Cam Chong. Can and also you can contact the Utah. Okay, so you can acquire more information, and also we will welcome you to this program. All right. And then that's all from me. Thank you, Miss Jolene. Over to you.
Thank you, Mr. Chong, for sharing the information for the program. And also thank you, Mr. Kevin, for sharing the topic. So here come to the end of today's live webinar. Last but not least, today's live webinar will be recorded at our official Facebook page, which is Utah for You, and uploaded at our YouTube channel. For further inquiry, you may WhatsApp, email, Facebook, or reach out to us. So thank you for joining us today. Have a nice day.